Hi, it's Larry Gaines from Options on the Open. We're the leaders in day trading using options. And I wanted to show you a video today on Fibonacci support levels for some of the major indexes. I thought it'd be nice to go through a couple of these since we had a pretty big sell-off this week. We haven't seen a downturn for a while in the markets, and I can show you how to use your Fibonacci retracement levels. A real simple method, but it really works great to pinpoint cycle support levels based on Fibonacci. So let's go through a couple. But first, before I get started, if you have not received my free ebook, this is Make Money Trading Options. It's a top 15 option trading strategies that I use quite a bit. Covers from iron condors to iron butterflies and straddles and strangles, and really some fantastic strategies. And it's a free ebook that details these strategies with graphic examples. So if you'd like this, please just go to my homepage, optionsontheopen.com, right here, optionsontheopen.com, and you'll see over in the left-hand corner this download for free. Just put your name and email address, click, and it's there, right there on the spot for you. So let's get started. A really great way to gauge where the markets are headed after a certain correction point is to use Fibonacci retracements. So a couple things on this chart. Just most people should have access to the SPY, which is the S&P 500 ETF. And so on this basic chart, you will see this is a daily chart. So each bar represents one day. And you know, some of the moving averages that a lot of the market players follow will be this 10 period or 10 day, which is in red, 20, which is in green, and the 50, which is in yellow. So as you can see, this trend had been following this 10-day moving average quite strongly, and it broke. And then I also like to use trend lines. So here's a trend line, and it's important that you draw them the same way. Take a pivot low, extend the line down, extend the line up. So pivot low here to this pivot low. Create your trend line, so you can see the trend line break. Now it broke here, went straight through the 20 and came down, went straight through the 50, bounced. So now let's put some Fibonacci retracement levels in. So first off, I'm going to start and show you kind of a progression of Fibonacci levels. And what you want to do is you want to take prior, like extreme sell-off pivot point lows, go to a pivot point high, extend your Fibonacci tracing lines from the low to high, and then do it again. So from this low to this high, and then I'll go from this breakout point here, or this low here, probably this breakout point here, to the high of the market move right there. So let's just do this, and I'll show you what it comes up with. So go in here, I'm going to get my drawing tool here, Fibonacci retracements. Bear with me. Okay, so we're going to go down here. We're going to start at this where the market bottomed in October, and then it peaked out here at the end of October. So you can see here from the pivot low of this move where it started to the high, we had these retracements where it broke through the 236, broke through this 382, and finally settled at support at the 618. So you can see here it had a pretty big sell-off, but it did hold support at the 618. So in a market, a strong, relatively strong market, you want to see a market correction maybe only go to the 382. If it holds the 382, that's a really good sign that the market still has some good strength. But as you can see here, it fell off to the 618, but then it retraced back up. So then the next level we'll go to is from this pivot low to this pivot. And let's see what happens with the Fibonacci. So remember this, it went down to the 618 and then corrected and stopped. So now I'm just going to take this low, I'm going to go here to that low where it sold off to, and then I'm going to go to this pivot high here. And you had a move back up to the high, and then look where it retraced to, the 618. So the point being is that the 618 is a pretty good level. If the markets are going to hold, they're going to tend to hold at that 618. So having said that, let's see where this potential move correction could possibly go, and I'll show you support levels that you should keep an eye on. So again, I'm going to take where this actual price, where the market broke out right here, this big green bar. I'm going to put my low here, going to extend up to the high right here. Alright, so this is what we have. These are the Fibonacci levels. So from this breakout point to the high. So here was a breakout point there to the high, here was a breakout point to the high, and here was this big expansion bar here. So what we've seen so far is that we came down and it went right through. It was a very powerful move down, that first down movement, part of the cycle trend down, and it stopped, went right through the 236, penetrated through the 50, and then took a bounce. But we have not gotten down to the 382 yet. So the probability is higher probability that the market will retest and probably test this 382. If it holds here at the 236, then this is still a very strong market, and this thing will take the next level up. But since it did break through this 236, I'd watch it for the next day or so, and if it can't get back above and consolidate on this 236, then the 382 will be the next major level. And then what you could potentially see, if it breaks through that, if it follows the pattern of the other two moves, then the market should stop here and hold up around this 130, 129.74 to 130, which would be right at the 618. So I wanted to bring that up, show you. It's a real simple way for you to follow the markets and know where their potentially support levels are. And one last thing before I sign off, I want to show you what the our cycle model, the power cycle trading model, where it currently has the long-term trend, and also I'll show you where the macro trend is for the S&P 500. So hold on one second, let me pull that up. Now, using the power cycle trading model, and this is a cycle trading system that I developed for all of our trading options on the open, we can use this across all time frames. And so using this cycle model across the macro time frame, I use a monthly data for that. The current cycle is still in an uptrend. The macro trend is still up, and this trend started back at the end of December 2011. So the macro trend's still up. The last time the macro trend was down was back here around July of 2011, right in this time frame here. So the cycle, let me see, the cycle started there actually June 2011, went down, and then we were in a macro trend. The long-term trend, which is measured by the weekly, I'll show you where that is. The long-term cycle trend just turned to the downside a week ago, April the 13th. Actually, the cycle changed April the 6th. So that's when the cycle shifted to the downside at the end of that week. And so we're currently in a long-term cycle trend down. And you can see here we've broken this long-term trend. So come follow us at Options on the Open and learn how we use the cycle trading model for all of our intraday day trading. And you can use it for day trading, swing trading, and other time frames. So good luck trading next week, and thanks for joining me.